placement record since inception, and IMS Ghaziabad boasts of rich academic and corporate alliances and state-of-the-art infrastructure as well. If you see IMS Ghaziabad's milestone over the years, we were established in 1990, and we got our MBA equivalent status by Association of Indian Universities in 2001. Then we got our ISO certification, NBA accreditation, NAC accreditation with A grade, ASIC UK accreditation in 2017, and recently we become member of AACSB USA Education Alliance. We offer these programs at our IMS Ghaziabad Lal Kuan campus. One being the PGDM in general. We have 7 specialization in general PGDM, postgraduate diploma in management international business, postgraduate diploma in management big data analytics, master of computer application, and executive PhD program in management in collaboration with Jamia Hamdard Dean University. If you talk about corporate and international academic alliance, IMS Ghaziabad has an MOU with IIMs for using CAT as qualifying score in admission procedure. We also have MOU with MCX, India's largest commodity derivatives exchange. We have also MOU with IBM, CSC, and BRICS Chambers of Commerce and Industry. We do have some academic alliances such as Fredericton University of Canada, Jamia Hamdard Deemed University, Northern Illinois University, USA, and Fort Hays State University, USA. If you talk about the intellectual capital of IMS Ghaziabad, it is well led by our dynamic director, sir, Dr. Alok Pandey, who's also the director and member governing council, Dr. Tapan Kumar Naik, who's our dean and professor academics. And we have more than 50 permanent faculty members at IMS Ghaziabad who has different experience in industry and academia. If you talk about teaching pedagogy that we follow here at IMS Ghaziabad, it is really new, that is Bloom's taxonomy, which focuses on analyzing, evaluating, and creating, rather than the old school philosophy of just remembering, understanding, and applying. We have outcome-based teaching pedagogy, which is a mix of digital evaluation with continuous assessment. We also have online midterm examination, comprehensive end-term examination with projects, assignments, live projects, presentations. IMS Ghaziabad follows a hybrid model with capability to organize all exams in both online and offline mode, as per the course requirement. If you talk about ROI at IMS Ghaziabad in terms of placements and everything, top 50 students bagged placements with average above 9 lakhs per annum this year. 326 plus job offers were made from 125 plus companies. Highest international package was 16.69 lakhs per annum, and highest domestic package was 12 lakh per annum. And the students have got the placements in diverse sectors such as consulting, financial services, research, FMCG, logistics, and several renowned companies in India and abroad. If you talk about sector-wise placement of PGDM, we have all the sectors that you can think of. It is all there. During this COVID situation, after March 15, the classes were completely dispersed, and we completed the syllabus through online classes through Zoom, WebEx, Google Meet, and the institute's official ERP. The institute also completed all the internal evaluations through institute official ERP without any hassle. All the midterm examination as well as the end-term examination have also been completed. If you talk about library at IMS Ghaziabad, we surely boast of one of the best library in entire Delhi NCR. We have more than 44,000 physical books, more than 8 lakh online books that are from Tata McGraw-Hill and World E-Library, more than 161 print journals, and more than 5,400 e-journals. And if you talk about e-resources at IMS Ghaziabad, they are both available from the campus as well as the hostel for the students to access. Last year, we presented Distinguished Alumni Awards to these 3 special alumni of IMS Ghaziabad: Mr. Rajiv Agnihotri, General Manager of Pawan Hans Limited, batch of 1992; Mr. Puneet Mehrotra, Senior Vice President, HSBC, batch of 1994; Vikas Gupta, who is a Managing Director, Talent, Deloitte, batch of 1995. As we already talked about the state-of-the-art infrastructure at IMS Ghaziabad, we do have a lush campus, 7 state-of-the-art computer labs, fully automated library with the books that we already discussed, air-conditioned classrooms, specialized language lab, corporate resource center with a boardroom, and all the communication facilities, electronic library, elevators for specially able students, medical facilities in campus and hostel, wherein the ambulance is available 24/7. State-of-the-art infrastructure, if you talk about all the basic amenities that you can think of, is available at the campus. Last year, we conducted 5 major international conferences, one being the marketing in the digital world, impact on the Indian economy. Another one was emerging perspective of finance and changing economic scenario in the month of February. International conference on transforming HR in the digital era. International conference on industry 4.0 and perspective and future directions in the month of March. The IT conference was held during the lockdown with the specialization into IT. This was all about IMS Ghaziabad. Now, I'd like to show you how we are preparing ourselves at IMS Ghaziabad during this COVID situation. Thank you so much. This was all from my side. Have a happy learning session. Over to Sir now.
So Agarwal.
Unmute, please.
Yeah, unmute. Yeah.
Pankaj ji, unmute.
Yeah, thank you. Sorry for that. I was unmuted. Okay, so this was an attempt to get you a glimpse of what we do here, so that you feel more comfortable attending this program. Now, without further ado, it's my time to invite a person who is behind this all, whatever you've seen. So, our leader, Director Dr. Alok Pandey sir, for his inaugural address and giving a welcome to our guests. Thank you, sir.
Yeah. Thank you, Professor Agarwal. Dr. Mofkadi, the speaker for today. Our other speakers in absentia, Dr. Dietmar Ernst, Dr. Pushkal Pandey, Mr. Gaurav Dawar, who's also part of the presentation and the organization of this program. First of all, many thanks, Dr. Mofkadi, who you worked with Professor Benenga for a long time. And in fact, when the book came out for the first time in 2006-07, we were really happy that someone had put Excel into such a wonderful use, because in financial teaching finance, I've been teaching derivatives for quite some time, almost 2 decades. And when you teach derivative, it's almost about data and numbers. And often teaching in the classroom becomes much easier when you start teaching through a tool where students also start realizing that yes, results can be had. You can get results quickly. And once they start getting results, they start learning better. So whether it is about basic models, so we are thankful to you. That was a wonderful book. I still have a copy of that book. And in fact, most Indian institutions have Professor Ben. He has done a yeoman service to teaching community by providing easy to access models. Although one part of the book was on VBA, Visual Basic Applications, And in Visual Basic, it was a little difficult for people to pick up things. But I still believe that even if someone gathers the basic first part of the book was into 2 volumes. And if someone can pick up the first part, it was a wonderful book to learn and teach finance. So if my colleagues who are listening to you today can gather the smaller versions of the books anywhere in the world available, there are cheaper versions now being sold in different countries. MIT Press is the publisher of the book, and wherever it is a wonderful learning. This program, when Professor Agarwal had proposed it, I had felt this was called 1 week online program on financial modeling using Excel. I see this program as a beginning, as a journey, as the beginning of a journey towards becoming an expert in finance, because this particular program probably is too short a period, but it does give a teacher all the access to data and resources. And if, in fact, probably the teachers would learn as to what should be the right resource to go to in terms of books or research papers or topics to look into. Because if I look into, even I don't know if faculty members who are using Excel for a long time understand how elaborate a software MS Excel is. You know, with some of the other, you know, add-ons or add-ins, you call them, if you use the Excel with an add-in, it becomes even more powerful than several other tools which are available today. So looking at basic financial calculations, looking into the ideas of available models which the book provides, or the other models which are available now. In fact, several experts in the world have provided models. Like, for example, looking at the investment models, it becomes much easier if you start using a variance covariance approach on a particular Excel file, and you know basic tools of Excel. You know, sometimes some of the very basic tools in Excel make your life much easier rather than, you know, doing all the calculations. So I feel that this particular program, as it moves further in next 3-4 days, would expose all the participants about all the possible tools of Excel which can help them in using this for higher order tools. I can see here there is one part on introduction to financial modeling. The second one is project evaluation using Excel. The third one, equity valuation using Excel, portfolio management using Excel, and derivatives with Excel with Black-Scholes pricing model. So probably each one of these models are very large areas. You know, you just can't say that I can teach you equity valuation, because equity valuation would need 6, 7, 8 different paradigms which talk about equity valuation, you know, right from using a free cash flow approach up to using, you know, equity as a call option on firm value. Or probably someone talks about the Ashwath Damodaran approaches of where, you know, you can start utilizing market multiples for calculating, and each one can be done beautifully using Excel. So I hope that each of these approaches which has been discussed here, the speakers in next 4 days would at least ensure that all the participants learn as to where the resources are available, even if they are not able to explain all the tech tools and techniques. And because all the attendees are largely teachers themselves, and we have made very sure, you know, there is a double check of the, you know, access to the program. We would not allow non-serious candidates to come in. I have discussed with Professor Agarwal on this, that any non-serious candidate should be immediately stopped from attending the program. So that, you know, for whatever 2 hours, 3 hours they interact with the senior faculty, we have a congenial atmosphere where we are able to learn, and we are able to learn some things which can be applied in the classroom as well as for even research purposes. So I feel that, you know, this is a big topic. In fact, if you look at financial modeling, right from financial statement modelings to something like, you know, leasing, portfolio models, efficient portfolios, it's a huge gamut. And say even derivatives, you know, largely if you look at derivatives, simulation of stock prices, apart from, you know, the application of option calculations. In fact, Professor Mofkadi, I'll tell you, one of the big problems this time this COVID crisis has thrown is the negative prices of the commodities. You know, and it was very difficult for people to find out as to how to manage this, you know, and this would be a problem to be modeled. Although some models are being used by the New York Mercantile Exchange for identifying when the commodity prices, because on 21st of April the crude oil prices went minus $37. So some of these active problems also should be discussed during this program, and some solutions where young people start talking about these things, and these things do not remain in the domain of the stock market experts only. So I wish the program a great success. I hope that everybody would come out better and they would pass on their knowledge, because the only way we can make this world a better world is when we disseminate knowledge to a wider audience. And I consider this model of webinars a wonderful way of, this has given us an option to talk to experts around the world. And I hope that when the program is over, all our colleagues who are attending it would come out very happy, and of course would disseminate this knowledge even further. So thank you very much once again, Professor Agarwal, organizing it, and thank you all the speakers and experts for supporting us in this initiative. Thank you very much.
Thank you so much, sir, for your words of inspiration and the way you have set the tone for the program. I think people have got what to expect, and they will certainly use this program to, as you said, as you rightly said, to set them on the path of learning. It is an immense area, and we are just trying to demystify what modeling is and what potential it holds. Okay, so not taking more time, now is the time to invite our Dean Academics, Dr. Tapan Kumar Nayak, who is a man who has always supported all the academic initiatives in the institute. Sir, Dr. Tapan sir, unfortunately we are running short of time, so may I request you to just briefly guide and inspire all of us. Thank you so much, Dr. Tapan.
Thank you, Professor Agarwal, for such kind words. Good afternoon to all of you. Honorable expert speaker of the day, Professor Tal Mufkadi, Professor of Finance, Tel Aviv University, Israel. Esteemed Director, Professor Alok Pandey, distinguished participants, and my dear colleagues. At the outset, I take this as my prime privilege and honor to welcome you all to this 5 days online international faculty development program on financial modeling using Excel. I'm also highly privileged to have Mr. P.K. Pandey, alumnus of IIT Delhi and IIM Bangalore, Professor Dr. Mahatma Ernst, Chair Professor of International Finance, NG University, Germany, Professor Pankaj Agarwal, convener of this 5 days FDP, Mr. Gaurav Davar, co-convener of this 5 days FDP, as our resource persons for these 5 days online international faculty development programs. My dear friends, we at IMS Ghaziabad since last 3 months, let me tell you, have conducted 6 FDPs on various pertinent topics. And let me tell you, this is the 7th for faculty development program organized by IMS Ghaziabad. This particular faculty development program aims to cater the extensive outcome on financial modeling using Excel. The objective of the financial modeling is to combine accounting, finance, and business metrics to create an abstract representation of a company using Excel forecasted into the future. My dear friends, organizing such a huge FDP for next 5 days takes a lot of hard work and commitment. I must thank the whole organizing team, including Professor Pankaj K. Agarwal, the convener of this FDP, Dr. Ankit Goel, the joint convener, Mr. Gaurav Davar, the co-convener, for the dedicated efforts. I must extend my sincere gratitude to our Reverend Director, a leader, Professor Alok Pandey, for his all-time guidance and follow-up of each and every academic activity to take our institute to a newer height. Before I leave, let me encourage all of you to take an active participation on this 5 days FDP, and I'm sure all of us would be wiser enough on this using intricacies of Excel on financial modeling. All the best. God bless you all. Thank you. Over to you, Professor Agarwal.
Thank you, Dr. Nayak. I would, where you ended, I will start from there. So you said about active participation, that is the key. If you really wish to take away the most from this FDP, I will again, at the risk of repetition, I've been writing to you about all this. Please open an Excel sheet and try doing whatever is being done alongside the instructor. Dr. Mufkadi was kind enough to send across an Excel sheet, which we have sent to you. We hope you have received it. So now is the time for raising the curtain from our great instructor, who of course does not need any introduction. Let me say that, but it requires us to tell more details about our instructor to all the audience present. I will request our joint convener, Professor Gaurav Davar, to do the honors, please. Professor Davar, over to you.
Thank you, sir. It's my privilege to introduce Dr. Tal Mufkadi. Dr. Tal Mufkadi is well known for being the co-author of a famous book on financial modeling by late Professor Simon Benega. He is a professor of finance and currently working as a professional academic program manager at Lahav Executive Education at Tel Aviv University. He has published 3 books in this area. His past affiliations include Kellogg School of Management, Chicago, Amsterdam Business School, Netherlands, Nagoya University, Japan, Tallinn University of Technology, Estonia, Copenhagen Business School, Denmark. He has also won a lot of awards in his career. His awards include Faculty Teaching Awards at Rekanati Business School, Tel Aviv University, Lecturer of the Year, Masters in International Finance, Amsterdam Business School, Teaching Award for Excellency in Finance, Vienna University of Economics and Business, Excellence Scholarship PhD for the PhD program at Bergler School of Economics, Tel Aviv University. And his area of interest includes financial economics, corporate finance, and investment theory. We welcome you, sir, at IMS Ghaziabad, and over to Dr. Pankaj Agarwal.
So, okay, I know that excitement has been sufficiently built by now. So maybe sometimes we were delaying it on purpose so that sufficient excitement is built before we present the, the protagonist of the day. So over to you, Professor Tal Mufkadi. Thank you so much.
Right. Okay, so first of all, good afternoon to everyone. Well, I was really impressed by the list. I wasn't sure if it's me or not, but I'll take all the compliments. I'm not sure I deserve all of them. What I want to do with you right now is I want to get you excited on working and teaching with Excel, complicated stuff in finance. I had 2 examples planned ahead. So I'm simply going to jump in. I'm going to share my screen. If everything is working correctly, you should be seeing my screen right now. And so I want to start with a really short discussion about who am I. So I'm not going to go over all the things that were said. I had the opportunity of writing 4 books in finance, 2 of them in English, which is called Principle of Finance with Excel, and the other one is the well-known financial modeling book. The 5th edition is going to be published probably next year. I just sent a manuscript to the publisher. Hopefully everything will be okay. And 2 books about finance. That's the only thing I know in Excel. In Hebrew, one of them is Introduction to Finance. The other one is Corporate Valuation and how to implement that. My plan for today is to talk about why Excel from all softwares, and then to show you 2 examples to do so, and then leave some room for question and answers. Since this is financial modeling with Excel, I try to keep the presentation as short as possible. So we have 8 slides, 2 of them you already saw. Why Excel? So before I go into the details, I really like this caricature over here. So this is the stage of your life, and this is your math skill required. So usually you start elementary school, you start counting, and then additions, geometry, and so on. You go to college, you do some integrations and stuff, and then you go to work and you do spreadsheets, okay? Which is a really nice summary of what we're gonna do in life. I would put spreadsheets here if I would do that, but that's the joke here. As of yesterday, if you Google Excel and finance, at least for my location, you get about 400 million results, which should tell you that Excel is extremely important in finance. Excel was released in 1985, and it's going to become one of the most important program in a workplace. It's a really great software. I'm not going to go into all the details. I was just trying to briefly describe the history of spreadsheets. you should be aware to the fact that, first of all, spreadsheet, the word spreadsheet, is coming from a sheet, an actual paper. People used to work like that. You know, I have some gray hairs over here, and I still remember CFOs working with pages and pages and pages, and then you would do one change, and then they will erase this change, do a new number, and then go over all the places in the spreadsheet to cover this change and the effect of this change. Think about how easy it is today. The really big advancement in this topic started in the early 1980s. It started with VisiCalc. This is the screenshot of VisiCalc in Apple. That's what's called a killer application. What is a killer application? You buy the whole computer just to have this application. And this has revolutionized sales of Apple. Lotus was the killer app for PC, started in early 1980s. Excel started for Mac at 1985, for PC in 1987, and ever since everyone is doing Excel. And maybe the next generation is going to be a web-based spreadsheet like Google Docs, Google Sheets. I'm not sure, but we'll see. If you have the time and you're driving and you like to listen to podcasts and to hear how important are spreadsheets in finance, I strongly advise you to use the link that I'm sharing here. I think we can share the presentation with you later on. So that's from Planet Money, which is a great financial podcast. And this specific is talking about spreadsheets and how important are spreadsheets in life and in finance specifically. So why finance is better with Excel? I would say the most important reason is because you can actually see and touch the data. You see a table, you know what is the number, you can click on that, you can change that, you can work with that, you can link to it. It is really, really, really intuitive compared to other things to manipulate data over there. And for most users, you don't need the programming language, fast, easy, and so on and so forth. And the way I think about working with Excel, and you know, the only thing I wasn't mentioning here is that I do a lot of consulting, a lot of pricing for institutionals in Israel and abroad, banks, financial derivatives, many complicated stuff. And the way it works is that you start with something, a model or something that you think of. I always model that in Excel, always, 100% of the time. Now, most of the banks would not price their financial instruments and derivatives with Excel. So they take the model, even the programmers understand better Excel, and then they either program it in R, Python, Java, or whatever software it is. But this step of bringing your thoughts into a model is best done in Excel. And you know, today, there are lots of other programs. The 5th edition of financial modeling, the one that I just sent it a few months ago to publishing, is doing Visual Basic as described before, but it's also showing how to implement everything in R. So I strongly believe that it will take us to the next step of how to understand the model in Excel and how to properly apply it into R. But that's gonna take about a few months until it will be published. So without further ado, let's see what's the difference between teaching finance on the board and teaching finance with Excel. And I want to take 2 examples. The first 2 examples is roles critique. I'll go over that. It's part of testing whether the CAPM model is a good model or not. I'll talk a little bit about that, and then we're simply going to implement that. And I'll show you that once you use Excel, at least this was the way I understand that. I was teaching finance many years before using Excel to teach finance. And then it totally changed radically the way I teach and understand finance today. And then we'll talk about the Black-Scholes model. I'll try not to step on toes. I know that you have a derivative, a pricing session, and I'll try to be brief and in a sense to be as precise as possible. Okay, so what is roles critique? Rawls critique, Richard Roll, 1970s. So in 1950s, risk diversification, Harry Markovich, 1960s, the CAPM, CAPM model is established. At the end of the 60s, early 70s, people started to test whether the CAPM model is a good model or not. We're going to do it in a sample really soon. And then this guy, the Richard Roll, said, guys, you cannot really test the CAPM model. Now, this is taken from the most, this is taken from the most probably important book in investment, which is called Investment Body, Kane and Marcus, and pay attention to what they are writing there. Okay, so there is a single testable hypothesis. The market is mean variance efficient. If you find that the CAPM is working, you actually find that its mean variance is efficient. I'm not going to read the whole thing. This is too detailed. If you present this in class, at least to my experience, there is a 20% chance that good students will understand that, bad students will just simply memorize that. And this is a really, really, really problematic way of teaching Rawls critique. So what I want to do with you right now is to test if the CAPM model is good, if the CAPM model is good, and to see Rawls critique happening in real life. Okay? Any questions? Comments? No? Okay. So what I have prepared yesterday is an Excel spreadsheet. It's an empty spreadsheet. I'm going to do everything with you. I'm going to do it slightly faster than I'm doing it in class because I assume that the majority of participants here already know the theory behind stuff. And I want to put the emphasis on the teaching of this stuff and not specifically explaining every detail. So what I did here, I went into the S&P 500 and I downloaded the largest 12 stocks. Okay, so Apple, Microsoft, Amazon, Google, Coca-Cola, JP Morgan, Johnson & Johnson, Visa, Procter & Gamble, Disney, Walmart, ExxonMobil. I think companies would look really similar. Questions? No. Companies looked really similar. I think other financial institutions that just simply skip. So 12 companies. This is not a research. You cannot publish it in any paper, but this will give you a taste on how are we testing the CAPM, the CAPM. And I also downloaded historical data for the S&P 500, which is a ticker GSPC. So that's the market portfolio, and those are 12 stocks. The way I did it, by the way, those of you who know can go to Invest Excel. This is a great Excel file. You can use that. You just feed the tickers and the dates, click OK, and then you get the data in a spreadsheet. This is really, really, really great. Okay, again, I'm going to share this spreadsheet at the end with all of you. So that's how I start class. I actually start class taking another 20 minutes of teaching them how to download data from Financial. But once you have price information, you're good to go. The first thing we're going to do, we're going to calculate returns, monthly returns. This is easy. The monthly returns are going to be, I'm going to assume continuous returns. So that's going to be ln of this divided by that. So if the price changes from 265 to 292, this is an increase of 9.7%. Those of you who knows me knows that I'm suffering from a really bad case of obsessive compulsive disorder, OCD. So I have to look at numbers and see that they are formatted correctly. So I'm formatting this as percentage. The easiest way to format number as percentage is clicking on your Control-Shift-5, and that will be the first tip of today. Control-Shift-5 automatically change the formatting to percentage, and if you did everything correctly, you can simply calculate that like that. Pay attention that when you're working with numbers, the last line will also show you, always show you an error, because if you need to start from something to calculate changes. So basically, I took 10 years of data, monthly data from 12 stocks. Okay, and the S&P 500 and so on and so forth. I'm skipping this stage right now. I'll talk a little bit about it later on. And okay, so now let's start analyzing the stocks. What is the mean return? So that's simply an average of column O. And you keep on doing this for all the stocks and the index, and you get the average return for each stock, average monthly return. Okay, what's the variance? Really simple in Excel, variance of the sample of column O, and you get the variance for each stock and the market portfolio as well. Really simple. For those of you who are asking themselves, how am I showing the numbers? There is a second tip of today. There is a formula in Excel called formula text. Formula text, and I'm putting it with the quotation marks and an arrow pointing to the left, and that will be showing you what's going on the left. Sigma, you can either calculate the square root of that, which is fine, or you can simply calculate the standard deviation, STDEV of the sample of column O, and you have the standard deviation for each stock. And if you have any question, comment, or if I'm going too fast or too slow, give me a signal somehow, and I'll try to be in any help. Now, when I'm teaching this in class, I'm starting to talk about betas, right? I'm trying to test the kappa and the CPM. What is the CPM predicting? It's predicting that high beta goes with higher return, low beta goes with lower return. So we need to calculate beta, and you want to explain to students what is beta. So once you have that, I'm taking, for example, Google, and I'm plotting. Each dot here is a month. I have about 120 months. On the horizontal line is the S&P 500. On the vertical line, it's Google. And you can visually see that Google is correlated with the market. If you add the regression line, you'll see that the beta of Google is 1.021, and the R square is 0.32. This is really easy to show students, and very intuitive to understand. And the next step, which is calculating beta. So beta, you can either calculate as the covariance over the variance. So for example, or directly calculated by using the slope of a regression. So Apple is on column O, and the market portfolio is in column A. And you can see the numbers that were explained in the chart before. Really easy to calculate betas and go ahead. You can also calculate alpha. It's not going to be with any important meaning, but if we're here, that's the intercept between column O and column. Well, we're having the column AA. And again, when I'm doing this in class, I'm talking about the alpha here of Google. Google would have an alpha of 0.0042, so about a little bit less than 0.5%, 0.42%. And if you'll find Google here, and we're not having a mistake, that's this number here. So student can link the theory to what they'll actually see and see the implementation. And the last thing is R squared, which is again, I'll just take the data from here. And the equation is called R squared. Very easy and very intuitive. So why am I doing all that? I'm asking my students, first of all, is the CPM model is a good model or bad model? How good is the model? So the answer is, let's see how good is it describing the data, meaning, can we see that high beta goes with high return or not? First of all, how noisy is the model? So what I show my students is the following thing. The first thing is, what's the, on average, what's the alpha here? Of course, theory tells us that on average, the alpha should be 0. But let's see the data here. So I'm taking all the stocks, not including the market, of course. And we see that the average is 0.53. Okay. What's the average beta? The average beta is 0.9. And what's the average R squared? .32, really, really, really low. So again, what is 0.32? The model can explain 32% of the variation. The other 68% is noise. This is not promising for the model, but, and then I'm doing the following thing. I'm telling them, you know what, guys? Let's take those stocks, the 12 stocks that we're doing here, and let's create an equally weighted portfolio. Let's create an equally weighted portfolio. So the return will be the average of the returns of the stocks. Pay attention, I'm not taking the market portfolio, the index. Easy to calculate that. Make sure the last line is not doing an error. Yeah. Now, let's compare those numbers to the equally weighted portfolio and see what can we learn from that. So, alpha is the intercept. So I'm asking myself, how correlated is this portfolio to the market portfolio? And I get that the average alpha and the alpha of the average are exactly the same. Okay, so that's one insight. The second thing is the beta, so let's do the slope. And I get that the average beta and the beta of the average are the same. Nothing surprising here. But now is the surprise. Let's calculate the R squared. Do the same thing. And even with this 12 stocks portfolio, you see that the average R squared, which is 32%, is not similar to the R squared of the average. Again, average R squared is not the same as the R squared of the average. What you see here is one of the most important findings in finance, 1970s, and this is, don't ever test the CPM model on individual stocks. Individual stocks are too noisy. When you're doing it, take portfolios. That's why any model that is doing CPM is doing it on portfolios, quartiles, deciles, bunch of stocks. This is why, because we are, the individual noise, what we call idiosyncratic risk, is canceled. And even with those 12 stocks, we can already see that the model is much, much, much better, 83% explanation power compared to 32 if you look at the individual stock. First insight, we're not done, it's only the beginning. Second thing is, I'm trying to understand, is this a good model or a bad model? So one comment, guys. Some of you are writing to me on the chat. I'm not looking at the chat. I'm briefly looking at, not too much. If you have questions, if I'm going too fast, give me a signal. You're under the participants. You can raise your hand or something, and I'll be more than happy to help everyone going on. Okay.
Just to interrupt, Professor Tal, we'll be taking the questions only at the end. Yeah.
Okay. Good.
You can go smoothly. Thank you, sir.
Okay, so I'll give the lecture, and at the end, if you have questions, write them down, and I'll be more than happy to help everyone. And again, this spreadsheet is going to be shared.
The moderator will select a couple of questions, and we will ask you the questions. So the audience can write their questions in the chat boxes. Thank you.
Great. Okay, good. Thank you. So now I want to test, this is why we're here. I want to test if this is a good model or a bad model. And again, what's the prediction of the CPM? The prediction is that the expected return is going to be RF plus beta times market risk premium. So the prediction is that high beta goes with high return. And we want to see if it's true. So I'm looking at my data and I see a bunch of stocks. This is called first pass regression. For each stock, I calculated the mean return and beta. So I want to know if high beta goes with high return. I'm not sure. So the first thing I'm doing, I'm going to check it, of course. The first thing I'm doing is I'm asking myself, what am I expecting to find if this model is a correct model, if it's a good model? And the answer is that I expect to find that the intercept is the risk-free rate. I went out and looked at the risk-free rate at the last 10 years. The last 10 years, on average, it was 1.4% in the US. So monthly return is divided by 12.12. I expect the slope to be, the slope I expect to be the market risk premium. Market risk premium is the return of the S&P 500 minus the risk-free rate. And, if I'm doing everything correctly, I want an R square of 1. I'm always, this is my desires. I'm not sure it's going to happen. Okay, let's see. Now I'm too excited. What's going to be the actual results? Let's see. And again, real life data, no theory here. Nothing is, I didn't make up the numbers. I just took the prices from the market. So what is the intercept? Let's see, intercept. And the Y's are the returns. And the X's are the betas. Again, pay attention to what's my regression. This is my regression. This is the Y, and this is the X, the X. Okay, so I'm feeding my regression with that. I'm getting something really disappointed. So the intercept is much, much, much higher than expected. I'm talking about 4.5 times higher. I'm not going to do the full check. It's statistically significant. Not promising for the model. It's actually really bad for the model. Okay, let's continue. Maybe the slope is going to be good. So I'm just copying here the parentheses. And the slope of that is kind of okay, slightly higher. Okay, good. And what's the R square? Very, very, very low. So let's see this visually, okay? If the CPM model will work, I expect to see all the individual assets aligned on the SMA line, security market line. So let's see if it's working. Let's plot that. Insert, chart, where I'm adding data. And the X's are the betas. and the Y's are the returns. Now I'm looking at that and I'm asking myself, is this the SML model? Is this a good model? Is this a bad model? I'm adding some titles. So that was the beta, and this is the mean return. Now, and again, if you really want to see the line, you can add a thread line and see the equation on that. And those are the numbers that we are seeing here. Not promising for the SML, actually really bad for the SML, which means that, you know, many practitioners, I have some colleagues, professors in finance who are thinking the same, saying, you know what, the CAPM is a nice theoretical model, but no one can implement that. Because when you try to implement that, you get results that are so off that basically tells you that the CAPM model is not working. Okay, and now I want to talk about Rawls' critique. Rawls' critique is saying the following thing. Everything we did here relies on the assumption, and that's an assumption, that the market portfolio is the S&P 500. But who said that the S&P 500 is the market portfolio? I don't know. It's a nice discussion. We can have this discussion, but no one necessarily told me that the S&P 500, maybe it's correlated with the true market portfolio. But Rawls told us, Richard Rawls, that using an approximate portfolio is not good. He said, you want to check if the CPA model is working? Use the true market portfolio. Now, the true market portfolio is a little bit more complicated to find. I'm not devoting this session to finding that. This is chapter 8 in the book. But basically, I'm going to do the tangency point with the envelope of those 12 stocks. Okay. I'm going to do it again a little bit fast because this is not what I'm trying to show you here. This is important, but that's not exactly what I'm trying to show you here. In order to find that, I need to create an excess return matrix. This is just helpful calculation, which is basically taking the monthly return and subtracting the average return. That's just the return minus the mean of each and every stock. And if we do it for all our stocks, and copy it all the way down, then we get what's called excess returns. Now, why am I calculating this excess return? Because if I call this matrix, this return A, then it turns out that I can really easily calculate the variance covariance matrix. How am I going to do that? That is, I'll show you in a second. The variance covariance matrix is A transpose times A divided by n minus 1. Think about the covariance. Covariance is between I and J is a summation of all events, probabilities, where you take I at the individual month minus the average return of I, and you check what happens to J at that month minus the average return of J. So that's why I needed to create the excess return matrix. Just a side calculation, nothing too complicated. There is a direct way to use Excel data analysis toolpath to do so. The reason that I'm not using it because when you use data analysis toolpath, you get hard-coded numbers and it's not linked to the source. What I'm going to do is going to be a formula that's going to be linked to the source. So again, what I need to do is to multiply those two matrices. Multiplying matrices in Excel is also really easy. You do it by M multiply, matrix multiply. And you want the transpose of A multiplied by A itself. And you want to divide it by N minus 1. We have monthly data, 10 years, 120 observations, about 119 N minus 1. But I like... What I like to do is to do count of how many months we have minus 1. Okay, so that's a long equation, but and probably have a mistake somewhere. Let me see. You know, the first rule of the computing industry, don't ever do live demonstrations. Let's see where is the mistake. This is 119, and this is, oh, I know. I see M mat and not M multiply. Multiply, and that should work now. Again, just show you the equations here and there. Okay, so we have the variance covariance matrix. Since I never trust myself, I'm always checking if the variance on the diagonal is like the variance that I calculated here directly, 0.00533, and it looks okay. Good. Once we have the variance covariance matrix, we can find the efficient portfolio. Efficient portfolio, again, a little bit too complicated for what I want to do right now, but this would be the efficient portfolio. What is this? You put 17% in Apple, 3.5% in Microsoft, 14.8% in Amazon. You go short on Google. You buy 6% of Coca-Cola and so on and so forth. Of course, they will sum up to 100%. This is the efficient portfolio. It's not the S&P 500. And what I want to do with you right now is to do this CAPM checking, CPM checking, check if the CPM is a good model, not based on the S&P 500, but based on the actual efficient portfolio. Let's do it together. So if those are the weights, and those are the returns, what is the monthly return on the efficient portfolio? Really easy. Those are the monthly return on the individual stocks. We're going to share the spreadsheets, of course, with you later on. And the weights are down here. You do this for every month. You hold the weights constant. And now the magic. Let's do the same thing as I did here, the first pass regression and second pass regression. Let's check the CPM, but not based on the S&P 500. Let's base it on the efficient portfolio that we just found. And I skipped a little bit, not a little bit, a lot, the efficient portfolio. This is a way to find the tangency portfolio. Look at that. It's chapter, I think, 8 in the textbook. It's not the heart of what I want to show you here, but this is not going to be very hard for you to get at. Okay, so the mean return is already calculated, right? I'm just reading it from here for each stock. You know what? I'm gonna calculate it directly. Sorry. The last one is not going to be the S&P 500, it's going to be the efficient portfolio. So let's calculate the average return. Once we have the weights, everything is easy. Average return of the efficient portfolio. And now I'm going to do the same thing. I'm going to calculate beta, but based on the efficient portfolio. So beta of this multiplied by that. This is should be AC. Okay, almost done. I don't know if you're as excited as me. Okay. What is the expectations if the model is working? This is supposed to be the risk-free rate. The slope should be the market risk premium. So that would be, sorry, the efficient portfolio minus the risk-free rate. And I expect to find an R square of 1. I hope that I'll find an R square of 1. Let's see what's the actual findings. Intercept. The Y's are the return, and the X's are betas. Exactly as expected. Amazing. Let's see if the slope is exactly as expected. Exactly as expected. Let's see the R square. Exactly as expected. This is surprising. If you ever see in social sciences a regression with R square of 1, something is wrong. Okay, I can tell you that for sure. But this is an actual data from the market. Let's look at this visually and then conclude. Let's add a chart. Where betas are on the horizontal axis and mean returns, actual data from the market, are on the vertical axis. And look at this chart. This is really striking to see. I'm going to push it over here. This is really striking to see the SML equation as we're teaching our students in class. 100% correct. All the stocks are located on the relative points on the SML. What we teach our students is that all the stocks are going to be there. It actually is. Now, again, think about it. It's as if everyone in the market went out to buy Apple. A second before that, you opened this textbook from the MBA studies and said, wow, that's amazing. This is exactly how I need to buy it. And that's how we buy it. R square of 1, 100% correct. Now, what is hiding here? And that's called Rawls critique. Rawls said that the CPM model is mathematically working. Asking yourself if the CPM model is working is like asking if 5 plus 8 is 13. I don't need to ask this question. This is 100% correct. But you have to use the market portfolio. And let me show you visually again, see the benefit of teaching this in Excel. I know it was slightly fast, but I wanted to get to this point and I didn't want to start with a field Excel spreadsheet. Let's assume that I'm changing one of the weights. Okay, so let's assume that this is going to be 0. Okay, so I'm manually going to do it. This is really bad. But anyway, we know it's not going to be the optimal portfolio. But look at my chart. So I'm changing this. And what you see here is that the model is starting to disperse. It's starting to be off compared to what it needs to be. And if I plug here 10%, you also get that the model is also starting to behave strange, and so on and so forth. So what's the message? The message here is Rawls' critique. If you use the market portfolio, it's an if and only if condition. You will get exactly that all the points are on the efficient frontier. If you find that it's not on the, on the SML, if you find that the points are not on the SML, you didn't find that the CPM model is wrong. You just found that the S&P 500 or the index that you used as a proxy to the market portfolio is not the market portfolio. Because I know for sure that if you use the market portfolio, all the dots are going to be straight on the line, 100% correct. And now we have to start understanding. Okay, I thought that I'm having a hard time, but I hear that someone is having more hard time. And another thing that the Rawls told us, and this is something you saw in the data, is that you can always find ex-post efficient portfolio. What is ex-post? In this data, 10 years data, 12 stocks, I can always find a portfolio, always, that is efficient. But no one told me that this is the ex-ante portfolio, efficient portfolio. And now we are starting to understand the theory, and this is one of the most advanced topics in finance, understanding the CAPM from the fingers. And you can start raising and asking questions, talking about, is the index efficient or not? What's the meaning of testing the CAPM? Can you really test it? It's like testing if 5 plus 8 is 13. No one can test the CPM, and so on and so forth. So again, I'm going to go to the next topic. I know it was a little bit fast, at least the technical stuff. I don't want to waste 3 hours with you here. The Excel spreadsheet is going to be shared with everyone, so you can look at that. And I want to move to the next example. The next example that I'm using is how to, at least how I'm teaching the Black-Scholes model and thank you, the Black-Scholes model with students. Now, the Black-Scholes model is hell for students. You know, this equation with S, N, D1, N, D2, D1, ln S over X, you know, so at least in Israel or where I was teaching, I see few versions of how to teach the Black-Scholes model. The first version is telling the students, look, guys, this is a recipe. Take 5 arguments, 2 from the market, S and R, stock price and the interest rate. 2 from the option contract, X and T, exercise price and time to maturity. This is a contractual thing. And 1 is your estimation, sigma. 5 arguments. Plug them in this model. Some of them are even calling it a black box model, Black-Scholes, and you get the price of an option. Okay. Some more advanced professors are also showing something like this. This is a string clip taken from my book of how to plug the data in Excel. I also do that, but again, I think it's a little bit shooting above the heads of your students. And what I want to show is how I'm teaching this model. So I'm going back to my spreadsheet. And the first thing that I'm doing with my students is something that I'm not going to do here with you, is how to model stock price behavior. Most of the students would intuitively, and I think like the history of finance also, would say, oh, okay, let's assume that the markets are efficient, so the return will be distributed normally with some kind of mean return and standard deviation. That's a fair assumption. And I'm showing my students that if you're using this to model, I'll show you exactly what I'm doing in a second, you may get negative results here. This is a negative stock price. I'm telling them, look, this is not a good way to model stocks. You don't want to assume normal returns. You want to assume log normal pricing. And I'm showing them that if you're assuming log normal pricing, this is the equation of log normal stock prices, you will never get a negative outcome. And once you have this in Excel, you can show your students the difference between the blue line. This is normal return. You can see that there is this left tail. The potential will go below zero, and log normal pricing, which is the orange dots, that will never fall below zero. And what's really nice about that is that if you click F9 on your Excel spreadsheet, meaning refresh, you can rerun this simulation over and over again. And you can see that the orange log normal distribution is never negative. So once I'm convincing my student that's the best way to model stock price is this log normal distribution, I'm starting to talk a little bit about what is this log normal distribution. So I'm telling my students the following thing. Look, let's assume that the stock price today is $100. Okay, it's written here. What would be the stock price? Is this dates or those are dates? Delta T is 365. What will be the price of the stock tomorrow? So I don't know what's going to be tomorrow. No one knows what's going to be the price tomorrow, but we know that it's going to be drawn from a normal distribution. If you want to be more precise, it's going to be drawn from a log normal distribution. Exactly that. Pay attention, in our model, everything here is constant. The only randomness is generated from this epsilon, standard normal distribution. So let's make up an epsilon. That's what I'm telling my students. Let's assume that epsilon is, I'm using Excel normal distribution with a random inside. So I'm telling Excel, you know what? I got a minus 0.11. If I click F9, I'll get something else, 0.12 minus, plus 2.2, and so on and so forth. So every time I'm clicking F9. So let's take a number. Let's take this, 0.26. What is 0.26? It means that the universe randomly selected a positive shock for the stock in this day. What positive shock? 0.26 standard deviations. Okay. Let's plug this equation and see if it's working. So that would be the stock price yesterday times E at the power of R, expected return of 15%, minus half a sigma squared times T. Delta T is 1 day, plus sigma I'm just substituting the data here. Times square root of the time times the epsilon. Okay, so what am I seeing here? For example, in this specific case, we started from a stock price of 100 yesterday. Today, we absorbed a 2.2 negative shock, 2.2 standard deviation shock. What is the daily standard deviation? The daily standard deviation is sigma times the square root of 1 over delta t. So that's about 2% shock. So in this simulation, every time you're doing something, Excel is recalculating the data. Okay, so let's take this. In this case, Excel randomly selected a negative shock of 0.4 standard deviation, meaning 0.4 times 2%, and that would be, that gave us the price of 99.21. So you do that, in this case, I did 500 days. 500 days, and then you get a stock path. And now you can start showing your students what's the meaning of that. So if you click F9, you can see a different stock path, and you can show them that looks really similar to an actual stock price in the market, which should give them the comfort of using the log normal distribution. But what I do another thing with my students. I tell them, you know what, let's start with a zero volatility. Zero volatility, you see the stock price goes up at 15% per year, everything is small. And let's take a dot, for example. For example, let's take day 300, and that's going to be the medium point. Now, what's happening to the stocks if you'll add the standard deviation, let's say 40%. Now, in this specific observation, let's do it in a different color, we were here. And I'm clicking F9. In this specific observation, we are here. Sorry. Here. F9, and we are here. F9, and we're here. And what I show my students is that you get less observations on the far side, a lot near the side. And if you imagine what's happening here behind the scenes, around this point, there is kind of a normal distribution. Depends on the variance and what you're doing. And this should give your students an intuition on what is the log normal stock pricing model that we are doing here. Once I'm done with that, I'm talking with them about, okay, let's start pricing an option. And I'm giving them the following example. Let's assume that the stock price is traded at $10 per share. I'm asking them to make up the numbers. And we are trying to price half a year option with an exercise price, let's put 11, you know. The stock would have a mean return of 15% and a standard deviation of about 35%, and the risk-free rate is 3%. Okay. So the first thing I need to know is what's the price of the option. I don't know what is the price of the option, but I remember from my studies is that the price of anything is the expected cash flows discounted by 1 plus the expected rate at the power of t. That's what I'm trying to do. So I need to understand what would be the expected cash flow 6 months from today. But an option is a derivative. It's deriving its value from the underlying asset. So if you want to know what's the option payoff at maturity, you need to know what's going to happen with the stock at maturity. That's why we were talking about modeling the stock price behavior. And of course, that's not it's only a random number. It's not a deterministic number. But let's have a lot of trials and see if we can learn something out of that. Okay, so I'm making up an epsilon exactly like before. Normal standard of a random number. And if this is the case, I know what would be ST. I have this equation right here. I can copy it from the previous spreadsheet, but anyway, I'll do that. So that's the price today. And that would be the mean return minus half sigma squared times t plus sigma square root of t times this shock that the universe is randomly selecting for this specific trial. In this case, we got a negative half a standard deviation shock, so the stock is going to go down from 10 to 9.31. And I'm going to do it a lot. I did it 1,000 times. It's not enough, but it's enough to explain the idea. 1,000 simulations, 1,000 times I randomly selected prices for stocks. It will be really near, a lot of them will be in the middle, 10% plus 15% return on half a period, like 7.5% return. Some of them will be on the extremes. So if this is the case, what will be the option payoff at maturity? I have an exercise price of 11. So this call option will give me the highest between 0 and underlying asset at maturity minus the exercise price. In this case, since the stock price is 11.67, then the call price would be 0.67, right? Okay. And the put price, the highest between the exercise price and the underlying asset at maturity. You do it 1,000 times. Let me give you the equations. You do it 1,000 times and you start to get the feeling on what's going to happen here. Because there was this video box. Let me just make sure everyone is muted. Good. You're starting to get the feeling here because the expected cash flow at maturity is simply an average of that. Okay, good. So the call option would give you on maturity about 0.97, about $1 on average. Sometimes it's going to be more, Sometimes it's going to be 0, sometimes it's going to be 3, sometimes it's going to be less. But on average, we're going to get about $1, I'm rounding the numbers. And the put option is going to give me 19 cents on average. It actually doesn't make sense. It doesn't. Let's see. Okay, that's what we have. But that's not the price of the option. That's the expected cash flow on maturity. This is only this part. What will be the price of the option? We need to discount it. And then I asked my students, okay, what is the discount rate? What is the discount rate by which you need to discount the expected cash flows? Now, usually the answers would be one of the following 3 categories. Some students would tell me risk-free rate, discount everything with the risk-free rate. Some would tell me you don't need to discount, which is for sure a mistake. And some would give me some kind of proper answer. Now, I will tell you something. Those who are telling me risk-free rate means that they already heard a little bit about finance. That's the wrong answer here. It's almost as wrong as telling me you don't need to discount it. Why is it wrong? The most important rule in finance, be consistent. It's the most important rule in life. If you have risky cash flows, match the risk of the interest rate to the risk of the cash flows. So you want to make sure that the risk of the cash flows and the risk of the risk embedded in the discount rate is aligned. And if you're discounting risky cash flows, the options payoff, with the risk-free rate, you're assuming that you're going to get 1.05 for sure. And that's clearly a mistake. Of course, it's a mistake. What we need to do is to find the discount rate that corresponds to the beta of the option. Now, that's not even the beta of the stock, which is the third option that I'm getting. The stock has an expected return of 15%, but the option would not have an expected return of 15%. Why is that? Because the call option is much riskier than the stock. So this should have been discounted with much higher discount rate, much than 15%. And I'm not going to get too much into it, but if you think about the discount rate of the put, that should have been a really low number, maybe even a negative number. Why is that? Because that's like a short on the stock. And the beta is negative. Negative beta, negative return. So that gives me a headache. And that's what I tell my students. In the 1960s, everyone knew how to do that. But no one knew how to solve that, how to find the proper discount rate to discount the expected cash flow. Until Black-Scholes-Merton. Black-Scholes-Merton came and they told us the following thing. Now I'm going to present it as an assumption, but actually it's a result in their paper. Again, I'm going to present it as an assumption, but they presented it, this was a result in their model. Black-Scholes told us, let's assume risk neutrality. Let's assume risk neutrality. What is risk neutrality? Risk neutrality is imagining, make believe. It's as if all the investors in the market are risk neutral. Risk neutrality. Now again, it's a little bit hard to understand at first sight, for sure for students who are hearing it for the first time, but let's assume that all the investors in the market are risk neutral. If they are risk neutral, they don't care about the risk. If they don't care about the risk, they don't ask for higher return for the risk. They don't ask for compensation on the risk. And if this is the case, then the risk-free asset will be discounted with the risk-free interest rate. The stock, which is risky, but all the investors are risk neutral, will be discounted with the risk-free rate, and the options are also going to be discounted with the risk-free rate. It's not that everyone really is a risk neutral, but we are assuming risk neutrality for pricing sake. Now pay attention. Risk neutrality doesn't mean that you are directly discounting this at the risk-free rate. Risk neutrality means that you're also doing the simulation with a 3% and not 15% return. If everyone is risk neutral, then the stock should also go up by only the risk-free rate and not the mean return. So I'm going to do this since we assume risk neutrality. Pay attention, the expected payoff on the call went down compared to the actual simulation. And the expected payment on the put went down compared to the actual simulation. Why is that? Because we are doing a simulation with a 3% shift and not 15% shift. Why is that? Because we are assuming risk neutrality. Now, if you think about the option, pay attention to what's happening here. We are biasing the expected cash flows to be lower than the actual one, 0.6 and not 1. And we are also biasing the expected return to be lower than the actual one, 3% and not higher than 15. And the intuition behind the Black-Scholes model, Black-Scholes-Merton model, Nobel Prize in Economics, is that those two events will cancel each other. And the present value is going to stay the same. So for the sake of pricing, you can assume that everyone is risk neutral. Don't forget to do the simulation with the risk-free rate. And then everything will be okay. What do I mean by being okay? That will give you the present value of the expected cash flow today. And that's simply discounting the cash flows here. I'm going to discount it with continuous return because the Black-Scholes model is a continuous model minus RT. Again, the risk-free rate, since everything is assumed to be risk neutral. So again, pay attention to what I was teaching my students. First of all, I taught them how to model stock behavior. Then I gave them that deep intuition behind how you price things and what's the meaning of risk neutrality. And once you have this in front of your eyes, you can see that the prices of the options should be something like 66 cents for the call and something like 80 something cents for the put. Of course, if you want to be more precise, take 10,000 simulation, no? And not 1,000. And when I'm done with that, I'm concluding with showing them what everyone else is showing them, which is the classic Black-Scholes model. Let me move this aside, see if I can do that. The classic Black-Scholes model, which would show you that the call price precise is going to be 0.66, very similar to what we expected to find here. And the put price would be 1.5, 1.49, which is sounds a little bit high compared to what I did here. Maybe I have a mistake. It's a good way to check yourself. Just a second. Yeah, I have a feeling that something is wrong here. Yeah, it's a negative thing and nothing can be negative. My mistake. The first and most important rule in the computer industry, don't ever do live demonstrations. I'm kidding. The put price is on average 1.52, and that would give you a price of about 1.5. And now you can see that the results of our simulation, that's called the Monte Carlo simulations, is dead on the Black-Scholes model. So what I tell my students is basically Black-Scholes, what they did, they took an integral, they did like infinite amount of simulations like that. Basically, mathematically, they've integrated the log normal distribution in order to get the prices, but this is not very different intuitively than what we did here. Mathematically, it's hell. Those of you who knows the Black-Scholes model knows that there is Wiener process over there and Ito lemma and stochastic calculus and things that are really, really, really complicated to explain. But we used Excel, and it took me, I know it was fast, but it took me like an hour to teach you something that most people would either hear about it or probably would never know. So I'm basically done. If this is, I think I'm like 5 minutes ahead of time, ahead of schedule, but if there is a question, comments, suggestions, ideas, I'll be more than happy to hear this. And I hope I showed you how to access, to attain or to present two of the most complicated ideas in finance to students or someone who wants to really understand what's going on.
Yes, sir. Really, I mean, it was very nice. Could you also, sir, like many of our participants are actually, having a very, I should say, very beginning level understanding of finance. And of course, your session was extremely good. So for the benefit of that section of our audience who are not so advanced in terms of finance knowledge, is it possible for you to share with them, at least the essential functions which anybody trying to learn financial modeling should focus on? I mean, whatever comes to your mind offhand, I know. I mean, you might not have readily remembering everything, but offhand, whatever are the best, most important functions which anybody trying to aspiring to learn financial modeling should learn? If you could tell us something about that.
Okay. Yes. So first of all, thank you. I'm aware that it was a little bit fast. I'm aware of that. But what I wanted to show you here is, first of all, that you can understand, even without understanding everything, you can understand the big picture here. And again, Rolls critique, if you take the actual market portfolio, you get exactly the results. If you not, no. There was a lot of mess up in the way. Black-Scholes, you understand what's going on. Now, to answer your question, what are the most important equations in finance or Excel functions in finance? So I would probably categorize this into two sections. The first one is data manipulation. So if you think about corporate finance, generally speaking, you would like to do that even if you're doing a corporate valuation, or when you're doing a business model, I don't know, project finance or something like that. And usually the process of analysis is that you will get a lot of information, usually in Excel or some other forms, and you want to take all those sources of information and digest them into one specific model. The most important equations, or the most important things to know, is how to manipulate data in Excel. So what I use a lot, really almost every day, is what we call data tables. That's by far the most important tool of Excel. It's an equation or tool, and I'll show you a simple example to get it. So let's assume that we have a 5 years project, and let's assume that the cash flow is minus 1,000, and then it's 400, and then it's growing at, I don't know, let's do 300, and let's assume that it's growing at 3% growth rate. I'm really making up the numbers. And oh, sorry, what is that? Okay. And also let's assume that the interest rate is, I don't know, 10%. Okay. So what would the normal person do? They will ask themselves, okay, is this a good project or a bad one? Let's calculate NPV and IRR. Net present value, NPV, extremely common, extremely important. Pay attention that Excel NPV has a bug, well-documented bug. In finance, PV is a summation from T equal 1 to capital T of the cash flows discounted. And NPV is the same thing, just from T equals 0 from today. Excel NPV, that's an historical problem because they copied everything from Lotus 1 to 3. Excel NPV is starting from time 1. So it's basically what we call in finance PV. It's not a big deal if we know that. So we will feed it with the interest rate and cash flow starting from time 1, important. And then we manually add the cash flow time 0, not a big deal, easy to fix. And you get a positive NPV. And just to complete the picture, the IRR equation, which is highly used in finance, is 17%. Of course, IRR is higher than the return. Positive NPV project, that's a really good project. But in any analysis that we'll do, we'll ask the question, how sure are we with the 3% here? Maybe the interest rate is not 10%, maybe it's 8 or 12, I don't know. So we want to do some sensitivity analysis. Sensitivity analysis, that's the most important thing that an economist would do. And the best way to do it is Excel, and the best way to do it in Excel is data tables. And let me show you how it's done. So let's assume that the growth rate is going to be, I don't know, 0, maybe 1%, 2%, 3%, all the way to 8%. And so now I'm asking myself, okay, what would be the NPV in each scenario? And so what I would do is something like that, just linking that. So I would take 0%, plug it here, see what happens to this number, and write down here 137.24, right? Typing it in. And then I'll go here, plug 1%. Of course, I'm not going to do it. And right here, 158.02, and so on and so forth. But there is a much better way of doing this. Sorry. And this is called data tables. What are data tables? You select the table with the number and the rows, data, what if analysis, data tables, and you tell Excel, look, those things on the columns, plug them here in the growth rate. And once you click OK, Excel is doing all those substitution. because we have a lot of random numbers in the background. So Excel is doing that. Give it a second. Yeah, okay. It will take Excel a second or two, and Excel will substitute the data and write it down. So whenever we're doing an analysis, we want to make sure that the result is not sensitive to our assumptions. That's called sensitivity analysis. And it's taking Excel a lot of time because of all the random numbers there. Let me try to speed things up. Okay, yeah. And what's nice about that is that you can do that for many variables. In our case, we can do this for the growth rate and for the rate and for the interest rate, the cost of capital. That's called a two-dimensional data table. If we're talking about practical equations, NPV and IRR are always used by practitioners. The only problem is that in reality, the cash flows are not aligned directly like this at the end of every period. There are some dates. This one is received on April 1st, this one is received on September 15, and so on and so forth. So probably, if I need to teach you two practical equations, I would tell you to use XNPV, XNPV and XIRR. XNPV is taking dates into considerations, and it knows how to deal with cash flows that are not in equal spacings. Highly used in practical analysis. And the XIRR, of course, is going to find you the annual interest rate when the cash flows are not equally spaced, like in the class examples that we're using. So those are the two financial equations and the method data table. Another really important is lookups. So there are VLOOKUPs, HLOOKUPs, but if you're using the newest version of Excel, there is one lookup that's going to rule them all. It's going to change everything that we know about lookups, and that's called XLOOKUP. I strongly advise you to look at that, because that would, if you have XLOOKUP on your computer, that's the only thing you need to know. When we used to teach advanced topics in Excel, we used to teach index and match and all those things. This XLOOKUP solves everything. Really, very important. Make sure you know that. Maybe I'll do another thing because I don't want to start talking about all the financial formulas here. I'll share with you guys the chapter of basic, not basic, advanced equations that are used in finance. I have a chapter of this in the textbook. I'll share it with you if you can find use of that. If there is an example of everything and how to use the equations, it will be great for everyone. Good. Questions, comments, suggestions?
That was wonderful, sir. Now we are waiting for some questions. If there are any questions, please write them in the chat box. All of you, use this opportunity to the fullest. Please write in the chat box. So there is a question from Dr. Amandeep Kaur, sir. Is it possible to create technical indicators, stock market indicators in Excel?
The answer is yes. I strongly advise you to look at Samir Khan's file. I'll show you his website right now. If you Google Samir Khan, Invest Excel. There are a few Samir Khans. The one that we're looking for is Invest Excel. This is a great website. Really, I sent like dozens of thank you emails to Samir Khan. So what he's doing here, everything is done in Excel. He's a really gifted computer programmer, and he has excellent spreadsheets, templates to do almost anything. So how to find yield to maturity, how to download data from Excel. That's what I did when I downloaded the data yesterday. Stocks traded on German exchange, durations, the latest stocks, tickers, you name it. That's a whole richness of things. And you also have technical indicators. I get, if I need to guess, it's not all the technical indicators, but once you have the data in your Excel spreadsheet, you can do whatever you want. But you also have technical indicators that you can use, and everything is free. I once donated one of my research money because he's really doing a great job. I'm sure you're going to find this very insightful. Good.
So one question, thank you, sir. Thank you so much. There's another question, Professor Anindita Chakrabarti, she has asked. So she is asking that whether we can use stock prices to calculate the values in indicators, or we have to use stock returns. I guess what she is interested to know is that do we need to pre-calculate returns and then feed them into formulas, or we can create a formula which directly uses stock prices and gives out indicators?
Okay, so first of all, thank you for the question. The rule in finance is that investments are scale invariant. What do you mean by scale invariant? I don't care about the absolute price of the stock. I care about what the stock is doing. If I put $100 on the stock, how much return am I going to get?
So can you come again? We lost your voice. We lost your voice. Can you come again?
Yes, sorry. So again, everything in finance is scale invariant, meaning if I put $100 on the stock, what I care about is how much am I going to get out of the $100 and not what's the absolute value of the stock. Pay attention that absolute values of stocks is a decision made by persons, by the finance head of the company. So I have a company with a value of $1 million. I decided to distribute 1,000 stocks. So each stock is going to be traded at $1 million divided by $1,000. And someone else decided to distribute 1 million stocks. So each share is going to be traded at $1. And for sure, nothing is going to change. It's just a decision of how many slices you want in the company, but nothing is going to change if you're investing in one company or another. Of course, I assume similar companies. So long story short, in finance, everything, and I'm actually lying, I'm going to tell you in a second, everything is calculated on returns and not absolute prices. Why am I saying I'm lying? Because there is one indicator that is using absolute prices and not returns. This is the Dow Jones Index. And there are mountains of criticism about that. For example, if we have the two companies that I was just talking about, your company, which is traded at $1,000 per share, and my company, which is traded at $1 per share, your company is going to get 1,000 times more weight in the Dow Jones Index compared to me, even though it's simply the same indicator. So maybe I should say all serious indicators are using returns and not absolute prices.
That's simply great, sir. Thank you so much. There's one more question. Anand Gaurav wants to ask that why excess returns are computed while testing CAPM? Why not directly we can use the total returns? What is the need for excess returns? What is the significance?
It's a good, okay, good. It's a really good question. The answer is you don't need it. You don't need it directly. What you need is the variance covariance matrix. the method that I use to calculate the variance covariance matrix is using a side calculation, which is called the excess returns. If you want to do it in a slightly different approach, I'll show you exactly how to do it. You can come here to the side and go to data. I assume that you still see my screen, right? Yeah. Data analysis, and once you have the data analysis, go to covariance. You don't need excess returns, you don't need anything, you just go here, show Excel the returns. You tell Excel that you want the output somewhere here. I don't know, I'll put it here on the side so we won't destroy anything. You do OK, and you get from Excel, Excel is going to calculate for you. It's taking Excel some time because I have like probably 10,000 random numbers running in the background. But once it will be done, probably a few more seconds, you will see that you have the variance covariance matrix without calculating the excess returns. This is just one method of calculating the variance covariance matrix. I don't know what's there. It's probably stuck out. I'll wait a few more minutes for that. The first rule in the computing industry, don't ever do live demonstrations. Yeah, it looks a little bit strange. Oh, here, we got it, sorry.
Yes.
Okay, so we got the variance covariance matrix in a different approach. The reason that I'm not using that is because this is hard-coded numbers, and I want the numbers to be linked to the source. But if you are not as spoiled like me, you can work your way out from here.
Yeah. I hope that answers the question of Mr. Anand Gaurav. Sir, now I have a question with your permission.
Yes, of course.
So my question is, what is the secret? Sir, we will not get this opportunity every now and then to interact with you. Sir, please share us a secret which very few people know. What is your secret of being so good at Excel? That will inspire us a lot, sir. I mean, if you could just share your secret, which perhaps you have not told many.
Actually, the secret is, I'm really feeling sorry for quoting Kung Fu Panda, the movie. The secret is that there is no secret. I'll tell you one secret that I strongly believe that is important in life and in Excel for sure. One of the best books that I've ever read, the best book, is Outliers by Malcolm Gladwell. He said, if you want to be an expert in something, you need to put 10,000 hours in this. So it's really easy that you see me here, you know, working on Excel, but I'm like 20 years working on Excel, 10 hours a day, all day. And the only secret is just roll up your sleeves and just start digging in. It's going to be slow. It's going to be hard at the beginning. Later on, you'll see that you're using this amazing tool to understand the most complicated stuff. You know, I did my PhD was on asset pricing and budget constraint. This is so high-ended, but eventually I did the calculations in Excel. Later I moved to Mathematica and stuff. The way to understand stuff by touching the data is amazing, really.
That's wonderful, sir. That's wonderful. And I mean, your hard work shows. I mean, there's absolutely no doubt about it. Evidently, it is there for everyone to see. And one last question, because time is also running out. And again, that is a question from my side, sir. So, sir, what is your biggest Excel mistake, which you feel sometimes that if I had not done this, perhaps I would have been faster or perhaps I would have been better? would you mind sharing one Excel mistake that you have made while in your journey of learning Excel?
I will. The best time-saving tool that I know is how to format numbers. And I did it like 20 times during the session, and I'm going to show you the best trick, the best time-saving trick. And I wish I would know it like 10 years ago, then I would save so much time in my life. So let's say that I have a number, I'm just typing in something here, 546, that's the number that I got. If you want to, if this is a long number, something like this, then most of the people would like to see 1,000 separator and maybe 2 decimal points if you're in finance. So most of the people would go to right-click, format cells, change it to numbers with 2 decimal points and 1,000 separator, which is nice. Maybe others would click on that, which is going to do the same thing. But if you want to be efficient, you don't want to lift your hands from the keyboard. What you're going to do, you're going to stand on that and click Control, Shift, and the number 1. Control, Shift, 1. And it's going to do the magic. Now, once you understand this trick, this can extend to many other things, because if you click Control, Shift, 3, that's going to be date. Control, Shift, 4, it's going to be currency. Control, Shift, 5, it's going to be a percentage sign. And so on and so forth. How am I remembering this? On my keyboard, which is an American layout, on the number 1, there is an exclamation point. So that's like the point in the decimal point. On the number 2, you have the @ sign, which is hours. Number 3, you have a hashtag, which is dates. Number 4, you have the dollar sign. Number 5, you have the percentage sign, and so on and so on. So that's probably the best trick in Excel I can teach you.
That was amazing, sir. That was amazing. Thank you so much. It was almost magic. And many of us who did not know this, I think they must be elated that perhaps one of the best things of the session has come at the end. And that's how I think the best things come. So I think we have just hit 3:30 in India, sir. And it must be, yeah, it must be approximately, I think, 12 or 1 o'clock in Israel. So we have taken a good share of your morning today. Now it's time to formally thank you, sir. As I said at the beginning, it was you did not need an introduction, but at the same time, I'm at a loss how to thank you. You are a person of your caliber and person of your stature. You agreed to speak in our session. Sir, we are extremely grateful. I mean, it means a lot for all of us. It has inspired not only us, it has inspired all the participants here. You talked about so many things, sir. The session was so rich, starting from why finance and why finance through Excel, what difference does it bring in? Then you talked about CAPM. I think many of us teachers today learned this trick that yes, CAPM does work, provided you use an efficient portfolio as market benchmark. So knowing this is one thing, but the way you demonstrated it was really an eye-opener. You also talked about some extremely useful features. For example, doing sensitivity analysis with data table. Also, you talked about, you gave us some very important resources, links to very important resources. Sameer Khan's resources, I think most of us are going to really visit it once at least and use it. And I will also encourage that if you like those resources, as sir has set an example, please donate. You also talked about functions of XNPV, XIRR, and then you shared with us your secret, the hard work, the perspiration that you have done. So 20 years into 10 hours. I was just trying to calculate this mind-boggling number, and I think that shows in your fluency with the topic, your command over the topic. So yes, sir, hard work has no substitute. And incidentally, sir, we in India, we respect the country of Israel a lot, and we know that the way Israel has built itself is based on hard work primarily. So no wonder that you also believe in that work ethic. You also very generously mentioned during the session that you will be sharing perhaps some material from excerpts from your textbook regarding basic functions which are useful. We will be looking forward to receiving it, sir. I will be sending you a mail, and once I receive it, I will forward it to all the participants. Sir, I really do not have words to thank you. You have inspired us with your presence. You have enriched our knowledge with the kind of vast experience and understanding and insights that you have in the subjects. On behalf of the Institute, on behalf of all the participants, on behalf of all the organizers, and on behalf of my country, India, we thank you so much, sir. We are really grateful for your time, and we are looking forward to having you in our midst again whenever there is an opportunity. And we wish you good luck in all endeavors of your life. Please stay safe. You are a precious man for all of us working in the field of finance. Please take care. Thank you so much. Thank you so much, participants. Before we sign off, all the participants are requested that we have just shared a feedback form on the WhatsApp group as well as email. Please make sure it takes only 2 minutes. Please make sure, I expect it. We take it as a responsibility. So we will collect your feedback and send it to Professor. He will be happy to learn and know that how his session was received. Of course, it was received well, but he is a man of data, so he would like to look at data. So I think that's all from all of us. We wish you good luck. And tomorrow's session, we have already sent you the course pack. Some people had issues. We'll be sending you the files directly now, today itself, by evening. One way of making the most of these sessions, as I mentioned repeatedly, is that please brush up your, this is not a very basic workshop. Please brush up your finance concepts, topics you have been told. Once you do that, you will see the difference it makes to your learning during the session. So that's all from our side. And thank you so much. Have a good day, good night, take rest, enjoy, read, and come back prepared tomorrow's session. Thank you so much. See you tomorrow. Stay here. Thank you.
Thank you all. Thank you all. Thank you for the invitation. The honor was mine.
No, sir, the honor was ours, and as it